Nothing has really changed, I think, in the overall macro sense of the markets from last month, 2 months, 3 months ago. The same headlines are still out there. The same headlines we're still focusing on. So I don't think it's really from a fundamental point of view, and we've gotten through earnings season with no real major shakeups. From technical levels, we've blown through every single technical level that's out there. We've had, in the last month, a 2,000-point move in the Dow. We've had almost a 200-point move in the S&P. So technicals, as much as I do like to look at them and try to help reel things in a little bit, when you have these types of swings at this point, they don't really help too much for me. I think it's investor sentiment. As we've discussed, this market went straight up. And everyone was waiting for what is going to be the catalyst to make this market turn down. Where's the shift going to be? The same catalysts are still there. I just think investors are just getting a little too stressed out over these headlines that are out there. We're talking, Brexit is the new headline today. We've talked about volatility in oil prices, interest rates, many different factors that are out there that's scaring this market. Tariffs. I think investors are just way too tired of these major headlines that haven't really come to fruition just yet.
Mark, Jonathan's certainly right that people are feeling stressed in the UK today. The British pound, a clear example of that. Do you think there's opportunities to pick up certain stocks in the UK or to trade the currencies around this?
Well, we don't trade currencies, just equity. So I would look at it as an opportunity to put money to work. We always seem like we have a cash balance. If we can find a discount from a private market value, a lot of the names we look at, we don't want to talk about on TV just because they're smaller caps. But yes, I mean, I think if you look throughout financial history, there have been the British pound devaluation in '92 that made George Soros famous, Thai baht debacle in the summer of '97, Russian ruble devaluation in '98 led to the long-term capital problem in September of '98. I would look at those as opportunities to find dislocations.
Victoria, there are a lot of things that are sort of being attributed to in terms of the market volatility. We've been having a lot of these conversations on our air in recent weeks. What are you watching, and where do you think stocks go from here?
Well, we look at earnings here in the third quarter. We're set to do EPS of about 27%. Over last quarter, you've got a strong consumer. We've got inflation numbers that came out this week that still show that we have tame inflation. So I think these are all supports for the market and can allow it to slowly start to climb higher. We saw a turnaround this afternoon on some potential China news. But when we look forward, we really want to look at companies' interest expense. That's kind of a leading indicator for us. It really gives us a good glimpse into where the strength of the company is going. Right now, it's about 3.3% of revenue, so it's contained. We look at corporate spreads, and even though that's widened out a little bit over the last week or so, we're still less than half of where we were back in 2016 when we had volatility in the energy market. So watch corporate spreads. And finally, CapEx. We really are looking at CapEx. That is something that we had anticipated would really push this recovery forward. We saw about 20% growth in the first half of this year. That's come down to about 13% in the third quarter, led by energy. So we would assume that's going to come back. But we really want CapEx to continue, help the productivity, which keeps unit labor costs low. And in a consumer-driven economy like the U.S., we need to see that stay low for inflation purposes.
Rick, plenty of comments from the Fed and bits of data today. How's it all shaken out for the bond markets?
I've heard many people today say something along the lines of, Jay Powell seemed really dovish. We're so surprised the markets didn't pay more attention. I think it's because the markets and people that trade the markets understood exactly what Jay Powell said. There is a bit of slowing. There is divergence. It's pretty apparent. I think that's why the markets didn't move. And I do think that the Fed continues to monitor. Another Fed official says, maybe we're within shouting distance of neutral. Listen, nobody knows where neutral is, but I think that Jay Powell is going to give the markets a crack at, changing his mind as to where neutral is. He's watching the fundamentals just like we are. I think on the dollar side, you know as well as I do that the volatility in the pound and markets mainly run by machines, especially from an intraday perspective, are really giving havoc to foreign exchange. They're also making a lot of havoc in the equity markets. All these headlines, machines move markets. But in the end, it's the human strategy that always wins out. And I think that this particular correction is more volatile because of the machines. But I've seen a lot of market corrections. And the way the equity markets fight and have such a big two-way trade, listen, I may be wrong, but I think this is an interim correction, far from the kind of big enchilada everybody, of course, is ultimately worried about.
Mark, what do you make of the sort of Fed unwind and what it's likely to do to U.S. equities? Will it continue even?
Well, I think the similarities to me, again, kind of going back through history, Mark Wilford is, 87. We took the 10-year Treasury from 7 to 10, and then we had a really one-day bad day. This year, we've taken the 10-year from 2 to 320, and we had a bad October. I think QE is designed to support asset prices. I think the reverse is an impact in them. The lone shining light has been the U.S. really big cap, FANG names up until last month. So, I think it's going to be interesting how things work out. I expect more volatility, but I would look at that as an opportunity to invest.